are you?
Doing pretty good, pretty good. Monday I got my car appraised, Model X 2023 CarMax. Wanted to give me $55,000 for it. They told me that they don't even allow like the FSD. They say when they wipe it, FSD goes away on the car. I just laughed and got the hell up out of there.
They said FSD goes away. Why?
That's why he couldn't add it to the offer, is that just because it has FSD on it now, that once I trade it in and they factory wipe it, FSD goes away for the next consumer. They have to pay the
You know,
$8,000.
you know what probably happened? Somebody probably transferred their FSD and they had a bad experience. CarMax had a bad experience because they thought they were getting FSD and they didn't. And that's
100%. I tried to tell him that, and he was very adamant. And I was like, I'm not going to fight in this CarMax. Give me this appraisal so I can get the diminished value for my car and get up out of here.
how did it compare to what Tesla offered you?
I didn't even use Tesla. I used the Kelly Blue Book. I just wanted those two because Tesla's offer is probably going to be closer toward 60,000 maybe, but Kelly Blue Book is like 75. It's like weird.
Gotcha. Okay.
You could
Nick,
send in your VIN real quick and just see what they offer you. They'll give you an email.
I know. I don't want to bother them. I got what I think I needed, and I think I'll be okay.
I
Well,
thought the trade-in offer is automated, right?
yeah, it's automated, so it won't take up anyone's time, and Yaman uses that for his data.
Okay. Well,
Yeah, Nick, I
I'll
don't
do
know
it.
what's going on, what kind of spaces you've been in lately, but in this space, you raise your hand, stay muted until and wait until you're called upon. Omar,
Hey, what's up? It's rate cut day. We made it.
it is rate cut day, yes. Let's talk some Tesla, and then Omar is going to type in the Fed action in here. Let's see. Actually, let's first talk a little Fed. So, Omar, so right now the probabilities are 50-50, which is amazing. And not only it's 50-50 for a 25 versus 50 base point cut, we also don't know what the reaction of the market would be either way. So there are multiple possible outcomes here in the next couple of hours. Nick?
Actually, I just wanted to correct you. According to the CME tool, it's 55% to 45% for 50 basis cut.
Thank you for keeping me honest. Man, those things are changing so fast. It's amazing.
Happens
I mean,
again, I'm
when
gonna have to kick you down.
the probability of a 50 base point cut went down to 10% after the CPI report, and then it went up to 80% or 70 something percent after Bill Dudley's opinion pieces. And then this morning, a number of ex-Fed officials went on CNBC and other channels and talked it down to 50-50, basically. It's incredible. Omar, what do you make of this?
Yeah, it does seem like maybe the futures markets are pricing in a little more chance of a 50. But then I've heard a lot of conversation with people saying, no, I think it's going to be 25. I just ran a little X poll informally. It came out a little bit in favor of a 25 basis point cut. So you really don't know if it's going to be 25 or 50. It could be that if we get a 25 basis point cut, there's an immediate sort of market disappointment from people who are expecting 50 today. On the other hand, if we do get a 50 basis point cut, I think that risks also spooking the market in that why are things so bad that we need to do a 50 basis point cut? Are things really, much worse than they look? Or, the market could receive it positively. There's no telling. It really depends not only on what the size of the cut is, but also, of course, Powell's statement in the press release and in the press conference after that.
So you're saying size does not matter. It's all about how you use it after in the press conference. Interesting.
Yeah, the size of this cut, but also the outlook is going to be important, and just also their commentary on how the economy is doing. Do they reassure people that this is looking like a soft landing, or do they say, "Oh, we need to cut 50 basis points right away. We're seeing concerns that this could spiral into a major recession." Right? If they made commentary like that, that might scare people a little bit. But yeah, I think if I had to just put money on it, I'd say we're probably going to get a 25, and they're going to give us an outlook for 100 basis points of cuts by the end of the year.
Okay, let's say we got a 25. So you said if you had to put money on it, you'd rather put it on 25. And what do you think the immediate market reaction will be? Let's say not immediate, but next 2 days, so by the end of the week.
I think that it'll go down after the press release, and it'll reverse after the press conference. I have no idea. I'm just, totally guessing.
Nick, what do you think? Do you think it's going to be 25 or 50? And whichever you choose, what do you think will be the market reaction?
I think it's going to be 50. It's crazy how it's changed over the past week, where it was like almost like a 5% chance all the way up to now 55% chance of the 50 basis point hike. And I think the market will react positive to it. But again, it depends on the language of the speech and how the Fed is how Powell talks with his language about the future too, future price cuts. But I think immediately it's going to have a positive reaction, and then there perhaps could be a pullback tomorrow.
Okay. So it sounds like Omar is expecting a 25, Nick is expecting a 50. And either way, they expect Powell to signal further cuts. And whatever the reaction is, it will reverse next week. Is that fair assessment of your positions? Okay, good. Nick?
Now a 61% for a 50 basis point cut.
Yeah, what is this? Like tick by tick stock price prediction? Let's talk some Tesla semi. I see Yoda in here. If he wants to come up and give us his updated thoughts on Fed action. But we have some Tesla semi news to cover. And the Fed news is going to come up in about 50 minutes. And then we'll mention it in here. We'll probably read the statement. Maybe talk about some market action. And then we're going to switch back. I want to talk a little about politics and regulation today. And then we'll have the Fed presser. And Omar is going to bring us through Bill, hopefully. Right, Omar? You're going to be able to bring Bill up?
Yep. And I think the decision on the cut will be out within 50 minutes. And then I think it's going to be another couple hours after that until the press conference.
No. Decision comes out in 50 minutes, and then the presser is at 2:30 Eastern and 1:30 Central, so 11:30 your time.
Oh, okay. 30 minutes after. Got it.
Yeah, exactly. You're thinking of Tesla's earnings announcements.
No, I think something got lost in translation with the time zones or something. But yeah.
Okay.
I'll make sure the thing works.
Yeah. Does he prefer to be called Bill or William?
William.
Okay. We'll call him William. All right. About Tesla, how are you? It's been a while.
Yes, hi everyone. I'm back. I was away for a couple of weeks traveling, but unfortunately got back with COVID, so I probably won't be speaking much. It hurts. So, but
Okay, well, I hope you get better soon. What's the latest on FSD rollout?
yeah, so we have version 12.5.2.1 rolling out. It's a slow and cautious rollout as always, but it's been pretty active. There were 4 waves in the past 48 hours, so that's a good sign. Looks like it's going actively, and hopefully it will go wider in the next few days, so we may get it's rolling out to everyone over the weekend. The good news, it's going to both hardware 4 and hardware 3 cars. It started with hardware 4. The first wave was hardware 4 centric. And then the subsequent waves went to hardware 3 cars. So all 4 models included. And the best news for those who have been waiting for a long time, it's about half of the customers who are getting these versions are those that are coming from 12.3.6. So they've been waiting for this version 12.5 for a long time, so many months. So I'm sure they will be excited to finally get a hands-free FSD and experience this silky smooth ride in the 12.5.
Thank you very much for the update. Perfect. So what percent of the eligible fleet today has hands-free, no nags on the steering wheel, approximately?
So it's if you look at the so this version right now is going to about 3% of the US and Canada fleet, all the entire fleet in North America. If you exclude, it's hard to say which are eligible or not. Based on the version number, the ones that have the latest branch would not be eligible, just the way the versioning works. So anyone who received update 2024.32 or .32.3, those would not be eligible. I'm sorry, I keep saying it incorrectly. Someone corrected me, but I apologize. It's not a big so those are about 25% of the fleet, so it's not a dramatic change. But if you just
Okay,
count
thank you.
eligible vehicles,
That's
it's about
great.
5%, close to 5% have it now.
Okay. So 5 to 10%, depending on how you count it, 5 to 20% of the, that's all I really need, just 5 to 10%. Still a minority. And maybe in the coming weeks, it'll become a majority of nag-free,
Yeah.
no steering wheel, which is amazing. That's great. I hope that it rolls out fast so I get less complaints. Omar?
Yeah, it's crazy how low the percentage is. My guess is probably what's happening here is that NHTSA said, okay, we'll let you do this, but we want really comprehensive data proving that it's really safer than the old system.
Okay, great. Yoda?
Yeah, I think the other reason why they want to release it slowly is I believe they are actually taking the feedback and doing some quick kind of feedback loops. I've noticed that there was this 4-lane merge onto a bridge that humans would do these sort of one-to-one maneuvers to kindly let the other car pass, and it did that for the first time, and it didn't do it a couple days ago. Uh, but anyways, did you want my take on the rate cut?
Yeah, always.
Yeah, I think it's gonna be Powell doing his victory lap today. He does not want to rock the boat at this point, so he's going to proceed with 25 basis point. He'll mention that he's considered 50, but wants to avoid undoing what he has, done. and that they'll monitor, the jobs KPI going forward, and are prepared to make a more aggressive cut on the next rounds. I think that's going to be basically the script.
Okay, thank you. All right, let's see. Our boy William is here. I love it. Jose is trying to connect. Let's go to Doge. Doge, go ahead. Doge, eGods Doge. Go ahead. What's your question? You may unmute yourself and ask your question. 3, 2, 1. Okay. Perfect. Do you think that's playing a role in sending him the latest update? All right, William. You have to stay on mute to raise your hand. Okay. Let's talk some Tesla Semi. Oh, Machine's here. Wow, he's early. Interesting. Yeah, if you're watching this on YouTube, please take a moment to vote in my creative poll today and like the video. Please like the video and leave a comment below the video after the live stream is over, because it helps it push out to new viewers, which we need for the YouTube channel. Anybody else on any final words? So it looks like the board is pretty much unanimous on 25 basis point cut. Is that right? Everyone seems to be expecting a 25 basis point cut here. Omar, actually, Nick said 50. I'm at 50. I'm pretty sure. I'm pretty sure Powell's going to cut 50. I think that they're very far away from neutral rate to start with the 25. I think the pressure on the economy is too high, and there are early indications that the inflation is going to continue to decline towards its 2% desired rate by year end anyway. So I think these, long and variable lags of monetary policy is at play here. Maybe it's not as long as it used to be, but we haven't yet seen the full impact on the employment labor market of having these rates so high and for so long. So I think Powell will cut 50, but we'll see. I created a list of people under the macro analyst account. Create a list of people who call for one or the other. I pinned it at the top of our screens. On the cut 50 side, Bill Dudley, who used to be the vice chair and New York Fed president, he's been very vocal. Robert Kaplan, Alan Blinder, Jeffrey Gundlach, who is the supposedly new bond king, Claudia Sahm, the creator of the Sahm rule, Bill Lee, who also used to work at Fed, Greg IP, I believe is the Wall Street Journal chief economics editor, and bond market. So bond market is slightly still voting for a 50 basis point cut. And by bond market, I just mean the Fed watch tool, basically. Cut 25, we have Roger Ferguson, who used to work at the Fed, and who also I believe was a vice chair. Richard Clarida, Loretta Mester. Mester is, she's always been pretty hawkish, and she seemed like I tried to listen to between the words, and she seems kind of like 50-50 on the 25. So she wasn't too, as the headline suggested, too much on the 25 side. And Jim Boyard is, he was the one who pushed the Fed throughout 2022 to go fast on the hikes. So he's still kind of keeping all hawkish. And then Ed Yardeni, and I listened to their presentation for this week just before I hopped on here. I mean, there are good arguments on both sides, but I see the 50 basis point cut arguments slightly better than the other side. And I think since Powell already said he wants to, he said they neither seek nor welcome further weakening in the employment market, I think was a big tell. So, but we'll see. We'll see. Since his speech at Jackson Hole, yields have plunged pretty continuously, actually. But the economics data that came out since then has been, not too alarming. But on the other hand, I think people are putting way too much emphasis on recent data points that are coming out. They're not that important data points. So, in the grand scheme of things, I think risks are a bit on the unemployment recession side. But we'll see. 39 minutes to go. Okay, let's talk some Tesla Summit in that half hour. Omar, did you watch the interview? The interview of Dan Priestley, who runs the semi program, I believe. He interviewed PepsiCo representative who have been testing the Tesla semis. What did you think? What were your key takeaways?
Well, the presentation was in Europe. It was really interesting to hear him say that it's prepared for international markets. I mean, the level of this partnership is actually much bigger than I had thought. I think they showed, 90 Tesla semi trucks that Pepsi's using. One of these trucks actually has 250,000 miles on it in 1.5 years. So they're really putting this thing through the paces. They talked about an international launch, the fact that it is going to support European trailers, and that it was built to be an international product from the start. And Tesla actually said they're not using any of their own diesel trucks anymore for the shipping between Giga Nevada and Fremont. They've moved entirely to using Tesla semis. So, I mean, that I think speaks volumes when you're able to move your own workloads completely and don't have to depend on diesel anymore. If it's possible for Tesla, it's possible for other companies too. And batteries is not exactly a easy load to haul, right? It's not filled with what did they say? Filled with, popcorn or something. Like somebody was making
Chips.
fun. Yeah, filled
Chips.
with chips, right? It's not exactly filled with chips. These are big, heavy batteries, and Tesla Semi has been able to do the job without a problem every time.
Yeah. If anybody has watched Tesla Semi interview, please request to speak and share with us your takeaways. And here are my notes from the interview, which I thought was pretty comprehensive. First of all, the overall tone of the interview was, I thought, very friendly, like super, super friendly. The PepsiCo representative, they seem to be working in very close partnership, and they're both sides are very excited about it. Hold on one second. We have a persistent requester here. Let's see what she has to say. Eleanor, what's your question?
Oh, it's about the batteries because I see the biggest problem with the batteries is getting the lithium material to build the batteries because that's the biggest problem we have right now.
Okay, thank you.
Well, wait a minute.
All right. Here are my notes from the presentation. The two sides seemed extremely collaborative. And here's a key comment from Pepsi representative was, we started on one site, but in our minds, this is something that has been proven, and it's now time to scale across North America. So that was a key comment. We're going to continue. Machine.
Well, I just wanted to address Eleanor's question about where the lithium is going to come from. I have it on.
Hold on. Nobody's wondering where the lithium. We have a packed schedule today. Second note. Okay, Alejandro.
Yes, I was wondering, does anybody know what's the weight of the tractor part? Because that's the biggest complaints of the naysayers, and I just don't know that answer.
That wasn't mentioned in the interview. Okay. Can I just go through this? It's time to scale across North America. Lowest TCO was mentioned heavily at the beginning of the interview. And another key comment from me was the PepsiCo representative said, quote, everyone talks about the turn radius of the truck. So all the drivers that have tried it talks about the turn radius of the truck. And I think they've been running about a few dozen of them. And they're coming up to close to about 100, sounds like, with this new site that they're building, which is going to have about 50 of them. So they've been testing dozens of trucks. So they have a lot of data, and they've been testing this for years now. And he says every driver has been talking about the turn radius of the truck. Okay, great. Driver feedback has been, I don't want to go to diesel, which I think Omar mentioned. On the challenges side, PepsiCo representative said, infrastructure is a big challenge. And he mentioned utilities, grid capacity. And he's kind of saying these things very quickly, like they're not kind of taking time to talk about each one of these. But, you know, if you listen carefully, he seems very frustrated about utilities, grid capacity. Infrastructure is a big challenge, which I think is a takeaway for us on the EV adoption side as well. Okay. He says, when they first started the program, they estimated 1 year for these megawatt projects. He said, I'm guessing he meant megawatt chargers. And by projects, maybe he's talking about also the storage side and maybe a solar panel side as well. And they estimated 1 year to get these installed, up and going, etc. But he said it's taken them 3 years. Deployments of megawatt level chargers, taking them 3 years. And this is PepsiCo. Okay, this is not your mom and pop truck company. And so that's a big problem. And it also, I think, has implications for the EV adoption side as well, like the cars, the sexy cars. And the Tesla guy, Dan, said it's going to be, he said it might be like it's going to be a bottleneck when they start shipping this in semi in Europe, because he mentioned in Europe especially, there are hundreds of small utilities, local small utilities, and although they do everything they can to standardize, they say they're big fans of standardizing process. It's going to be very difficult. So it's not just about producing the semi. You also have to get these megawatt chargers. And Dan said, when they shift to Europe, they're going to have to maybe go from depot charging, which I'm guessing is charging at the site, like PepsiCo's warehouses, depots, etc. Relying on more publicly available charging in Europe, they're going to have to do that. And I'm guessing to a certain extent that's going to be true for the US as well. So charging infrastructure is a limiting factor for the Tesla Semi program. And in my opinion, so this wasn't discussed obviously in the Semi interview, but in my opinion, this is also a problem for like the local aspect of these regulations is also a limiting factor on Tesla Energy as well, where there's power walls. I think, in my opinion, a Republican administration would accelerate the world's transition to sustainable energy, at least the US, materially, because of maybe streamlined regulation. I think Republican administration can do a better job, or maybe would be more willing to take those actions to streamline regulation. And I don't see that kind of willingness from Democrats. They just seem to be adding more and more regulation. So, this is politics is a topic that I don't like, but it is necessary in the context of Tesla's mission, Tesla's sales, profits, implied value of the company, intrinsic value, and also the stock price. So I understand why Elon is so heavily into politics this year. This is very important for the semi project, power walls, mega packs, robotaxis, and God knows what else that we don't even know about. First, Omar, that machine.
Yeah, I think the problem you mentioned is a very real problem, especially for the semi, right? For passenger EVs, you can go charge your passenger EV at home at a level 2 charging rate, which is, you know, 32 or 48 amps. It's not much. Many people are just charging off a standard 110. Now, when you talk about a megawatt needed to fast charge a semi, that's 4 times the peak rate at a Tesla supercharger. So you've got 4 of these things. It's like you need a 16 stall supercharger at that location. And that would be all fine and good if you just needed the building to approve it. But the process of grid interconnection and building out grid capacity is slow, cumbersome, and covered in red tape. You cannot get, I mean, there's so many even renewable resources that are not being connected to the grid because it's just such a slow, cumbersome process that is just covered in red tape. It really is holding us back. So, I mean, especially when you look at the semi and you want to build a fast charging network that allows the semi to cross the country, how do I get 5 megawatts of power out into the middle of nowhere in Montana or Kansas? The cost to build out that grid interconnection capacity and the red tape and bureaucracy associated with getting it up is extremely prohibitive to electric
Yeah,
semis being widespread in the United States.
yeah. Okay, machine's about to talk, and I just want to warn everybody. Make sure when you're listening to machine, think very critically, because about half the things that he says are wrong. He has a really poor track record of coffee bets lately. I don't know what's going on. If you're distracted, we need to get you into therapy. Please go ahead.
Well, I'm in a lot of therapy. Thank you very much for your concern. But this space is like anti-therapy, basically. And that's why I try to avoid it like the plague. But in this case, I had to make an analogy. And have you ever seen the original Austin Powers movie where he manages to get his little golf cart stuck perpendicular in between the hallway walls? He can't get it out. That's the position I feel like Tesla and Elon Musk are in now in respects to the United States government. On one hand, you've pissed off the Democrats who are generally pro EV, pro infrastructure for EVs. And on the other hand, you want to support Republicans who, at any whim, yes, they may be more likely to reduce regulation, but also might just simply slow down the EV acceleration by blocking these sort of things and appealing more to their oil base of industry policy supporters. So this is happening for Tesla, and personally for Elon Musk, we can see he's going down this path to where he may get himself and the company screwed with regulations or litigations unfairly, presumably. And that's you're talking about politics. That's the issue. He's actually, Elon Musk has driven the cart like Austin Powers, and he's gotten it stuck between the walls. And my last point, quickly, to Eleanor's question about where is the lithium going to come from for the semis? Well, I have it on good authority that there's an incoming supply of pagers from the Middle East that have little lithium batteries that we can use.
Oh, sorry, I had to laugh. Okay. All right. What do you think the Fed's going to do? 25 or 50?
I'm guessing 25. I agree with you. I think 50 is more appropriate. Just simply given that earlier this year, I would have thought it would have been safe to cut 25 then. And now, obviously, things have changed and accelerated a bit more downward. So I would think 50, but I think they're going to go with 25.
Yeah, I don't really understand. I mean, that's what a lot of people said last week. That they should do 50, but they think they're gonna do 25, and that doesn't make any sense to me. Are you saying the Fed is dumb?
Yes.
Yeah, that doesn't make sense. So what are you gonna do if they cut 50? Are you gonna say, okay, they're smart?
I'm going to say that I was right either way.
Okay. What do you think about did you watch the Tesla Semi interview? I mean, you don't have to watch it. I just summarize it, all the key points. What do you think of it? What do you think about the Semi program?
I did not. I don't care. Don't care.
Well, the Semi is going to produce $1 billion in profits before robotaxis and Optimus, Omar said yesterday.
Omar makes every speculation out of his ass and every other orifice.
You don't agree with that?
Well, that he uses every orifice or not? I mean, listen, I haven't studied his body. I don't know how many proclamations come out of which parts, but I just think Semi, in terms of its overall valuation, earnings contribution to Tesla, Tesla's valuation is at a premium for all of its automotive and energy. Okay. So if you want to invest in this company at this share price, it's solely due to Robotaxi and Optimus potential earnings in the future.
I don't know. I think that's a very simplistic view of company valuations. Omar?
Yeah, I mean, if you just want to look at it on the surface level and say what's the EPS contribution going to be in 2024 or 2025, it's easy to dismiss it. When you look at the longer term vision of we can entirely move off fossil fuels, even heavy duty vehicles, we're even going to try and electrify those, its significance is greater than the EPS contribution in a future where all vehicles, including heavy duty trucking, commercial buses, that kind of stuff, are also using electric. It's a very different future for the company, their mega packs, their battery projects. And also, if you look at just the Tesla network, the value of a rideshare mile is a fraction of what you can do in commercial shipping. I'd go so far as to say in a mature autonomous network, more than 50% of earnings would come from commercial freight, an automated semi. Have you seen how many things are moving across the country like this compared to probably, less than 50% for passenger rideshare?
Yeah, and I think the comments that it's in our minds, this is something that's been proven. It's time to scale across North America is interesting. Good comments. I think we're going to see hundreds of these things across the country in 2025 and thousands of them going around in 2026. Scaling beyond that, I think the infrastructure issue that we just talked about is going to be a limiting factor. Machine, what do you think about that? That the idea Republican administration can speed up the infrastructure build out that's necessary for Tesla Semi and Megapacks?
Like I said, it's a total wild card. In theory, Republicans are more likely to cut red tape and make it possible to speed up the build out. On the other hand, Republicans are more likely to just say, nah, let's just block this altogether. So you really kind of it can go either way. And I don't know how you're going to be able to predict exactly what the Republican support is going to be for EVs if they have control of the White House and say if they control all three branches of government, both houses, Senate and the House of Representatives. Then who knows? I don't know who they're. I just don't know exactly where it's going to play out. So I get your point that that's
Omar,
possible.
what do you think about this idea that Republican administration is unpredictable and they can say one thing during the political campaign and then when they come to power, Trump may just pull the plug on EVs, whatever that means?
Um, we've seen a Trump administration previously. I think EVs did very well. Some of the best years of growth for EVs. And a lot of these policies that Democrats enact to try and help the EV industry really are not great for the EV industry. Putting price caps on how much you can charge for an EV kills the ability of the industry to make a profit. And every year, as price levels rise, that price cap gets more and more restrictive. These battery sourcing restrictions, they raise costs. I mean, who gives a like, yeah, okay, give production credits for American batteries, but if we can get cheap batteries from China and accelerate electrification, that's something we should be doing. And we can recycle those batteries and continue to use them once we buy them. So, a lot of these, oh, we're so great for EVs. We're going to give 7.5 billion for charging. Oh, how many chargers did you build? Not that many because we didn't want to give, enough to Tesla. So, a lot of these policies sound great on paper, but you know, it it hasn't exactly been the boon for EVs we imagined. I was excited when Biden got elected. I voted for the guy because I thought he would be good for EVs. I said, "Oh my God, this new EV tax credit, it's going to be great. Sales are going to take off." And it didn't happen. Actually, hybrid sales took off because of that regulation.
Exactly. Machine, what do you think about the idea that Biden administration is all talk? They did not help EV sales; they helped hybrid sales. They talked about spreading infrastructure, growing the infrastructure, charging infrastructure, and even though they allocated billions of dollars to it, there's nothing. They have nothing to show for it. He has repeatedly um, ignored Elon, SpaceX, Tesla, that ridiculous EV summit at the White House, where he did not invite Tesla and invite everybody else and said, Mary, you're leading and it matters, or something along those lines. I mean, this is a lot of evidence that this guy hasn't been good for Tesla. And Omar is right. Under the Trump administration, Tesla had some of its biggest achievements and highest growth.
Well, I know you guys aren't very good at listening, which is unfortunate because this is an audio space and that's your only sensory input. But I said that Tesla and Musk are stuck in the hallway between two administrations. I agree they've screwed themselves and they're not getting much benefit from the Democrats. So you can't bring up the point that Republicans might slow things down by also bringing up that the Democrats slow things down. I already agree with that. My point is that on the Republican side, that you don't know if things like Trump trying to rescind the IRA bill or take away regulatory tax credits or whatever they can try to do to slow things down is out of the realm of possibility, is absolutely in the realm of possibility. It doesn't mean it's better or worse than what Democrats could do. It could just be that both administrations might take actions that hurt Tesla. And part of that might be because the CEO keeps getting involved in areas that help him in his quest for quote unquote free speech. Let me emphasize there the quotes around that, and sacrifice his companies along the way.
Omar, what do you think?
I think it's going to be fine either way. Elections are so dramatic, but if Kamala Harris wins, then I accept her as my president, and hopefully Congress and the courts sort of push back on her doing anything too crazy, like putting price controls on groceries or something like that. And I think if Trump wins, there's also some concerns, just like with Kamala, but I would accept him as the president and trust that everything is going to be okay. We've got a system of checks and balances, and I trust in the American people to make the right decision.
Yeah, I don't know if I fully agree with that. I think the regulatory path could be very different under the two administrations, and it's very important for Tesla Energy, Tesla Semi, and other topics. I mean, other companies like Neuralink, SpaceX. I think those things could look very different under the
I
two
mean, I
administrations.
don't disagree with you. You're absolutely right. I mean, I think Elon is trying to tell everybody very clearly one administration is being a pain in the ass, and one likes me and says they want to help me. So if you're voting just based on what would be good for Tesla and SpaceX, then listen to Elon. He's not an idiot. He hasn't gone crazy. He's saying, hey, one side literally wants to throw me in jail, okay? And the other side wants to help me. If Trump's elected, they'll give him a contract to go to Mars, you know? And SpaceX will go try and do that. They'll pave the way for autonomous vehicles to be deployed. No question about that. I think either way it'll be fine. It's
Omar
not the
got a
end of the
call, I think. Can you guys hear him? Oh, you can't hear him? Okay. I'll be back. Chris,
Yeah. Hi guys. Just really quick on machines part.
Chris, when you come up, again, as a reminder, this is the same as yesterday. Tesla Live is a lot more fast paced than AI amateurs. Okay. When you come up, don't say hi. Don't say I just want to say this. Just say it.
Okay. Respect to Biden Harris, I think that this entire thing relates to all that none of the Tesla companies being union shops, and I think that's why they're snuffing them. Machine, I really think that Semi is going to be hugely successful by 2027, and like this broadband initiative that the Biden Harris administration put into place with the objective of actually lighting up a bunch of homes, it's ridiculous that they didn't make use of SpaceX and are trying to do this again. I think all related just to union jobs.
Machine.
Yeah, I don't disagree with any of that. I mean, I think absolutely Democrats are pissed about dumb things like unions or whatever else they want to slow down Musk's companies. Yeah, sure. I agree. But all of a sudden to think that Republicans are going to be super pro EV renewable energy when a lot of their constituents are anything but, and in fact antagonistic against it, is very, very optimistic take. So I tend to be more hesitant in thinking right now either one is really great for Tesla. And as for the Semi, I'm not saying the Semi isn't going to be a success. Let's say the Semi produces $1 billion in profit in the next few years. That's great. Go value out what $1 billion in profit is from a company if you look at free cash flow discounted backwards or PE ratios. I mean, you're going to add like 30-50 billion dollars to the market cap. That's like a nice little thing, but the company is already valued at 5, 6, 700 billion. So we're talking like one day's fluctuation in share price to add the value of what Semi contributes. It's not to say it's a great thing from the renewable energy space and climate change, but in terms of Tesla's valuation, it's not going to change much.
Machine, under which administration do you think nationwide approval for robotaxis would be easier?
That is a good question. I think
It's
for
a very
that,
simple question. I thought it was a rhetorical question, but
yeah, I think Republicans for sure.
thank you. You don't have to complicate it. It's Republicans. So if you don't think SEMI is going to be intrinsic value significant, then you obviously you think robotaxis will be, and a nationwide approval is a major milestone for Tesla robotaxis. So then there you go. There's your argument. What else do you want?
Well, whatever. I agree with you. I said at the beginning, the only thing that matters is robotaxi and Optimus. So, yeah, if we get to a point where robotaxis are actually close in terms of software development, then Republican administration is more valuable to Tesla.
Under which administration? Approval of Starship launches, Neuralink milestones will be easier.
Got to be Republican.
Okay. So doesn't that mean Elon has to worry 10 times less about those things and can focus on more on Tesla?
That's a good point. Maybe. I think he just might focus more on his behavioral addictions, which is tweeting.
Okay.
Man
Nice.
gives sight to the blind, saves astronauts, prevents car crashes with FSD, and he's got one problem. He likes to tweet a little too much. He's gotten himself into multiple lawsuits and criminal securities fraud cases because of it. But, you know, none of us are perfect. We all have our vices.
Listen, listen. I know, Omar, that you live in a bubble in San Francisco where there's literally homeless strewn across each intersection, zombies around Civic Hall with needles sticking out of their arms. But here in the rest of America, even down south on the peninsula, tens of thousands of people are not choosing Tesla brands now because of his actions. In fact, when I go listen to
Speculation.
NPR,
Speculation.
no, I go on
You have
NPR now.
no proof. You have no
I
proof.
have lots of proof.
Zero proof. Zero proof.
NPR, listen, when I'm on NPR, I go listen to NPR.
So why
I
do you
hate
think
NPR.
the Cybertruck's outselling Rivian? I thought everybody was choosing Rivian instead.
Why is Rivian going bankrupt?
Listen, I'm not talking about Rivian. These people are all dumb. I'm just saying on NPR, the hosts now are literally talking about they're worried about safety of large vehicles, and they're all anti-large vehicle. The stupid liberal rag talking about big things are hurting the environment. And the host is literally like, I have to apologize. I have a Tesla Model Y, but I bought it before Elon became the way he is. And I'm like, oh my God.
Okay, well, let me ask you this. Did she sell it?
It wasn't a she, it was a he.
Did he sell it?
No, he didn't. It's
Exactly.
hypocrisy. Trust
You know
me.
what
why
I
do you
call
care?
that?
So why do you care?
Remarketing.
Why do I care?
Exactly.
Because
Doesn't matter. He still
self-hating.
chose to keep it. It only matters if only. Can I? Excuse me. I am the host. You are an infrequent speaker. Okay. The only thing that matters to the company's valuation, if that guy goes around and sells his car. A lot of people talk, but look at their actions. Actions over words. Bugs of Walmart.
Yeah, I think, it's political season, so we're all getting a little bit Republican Democrat. Let's look at something like the CHIPS Act. The new Apple 16 is going to have a made in America system on chip, made in Arizona, a new fab that's making 5-nanometer chips. They both want the same thing, which is keeping China at bay. If you look at China right now, they sell a Tesla Model 3 like clone basically for like $18,000. The West is freaked out about cheap Chinese cars coming in, and it doesn't matter if it's left or right. The main thing is to protect the American automotive industry. And Elon's got, Biden kind of, scoffed at Elon and didn't invite him to the thing, so that's why he's pissed off at him. But the main thing that matters is keeping the Chinese cars out. And they're both going to work on that regardless because they want to protect the American industry. And that's really long-term what matters.
Okay. 5 minutes to go to Fed decision, right, Omar? Yeah, 5 minutes to go. Any final Bull 2035?
Hey, I had a question on the Tesla Semi. is there a way that those can do a refrigeration in the trailer? Because we do a lot of refrigerated and frozen goods, and I saw some articles several years ago saying that it could do that, but I haven't actually heard it doing that.
Yeah, they do have a way to run a refrigerated trailer off the battery, but obviously it's going to decrease your range.
Okay, great. Just to kind of summarize this discussion, I mean, I think it's very clear. I mean, in my mind, it's very clear. If you are you care about Tesla's mission, you care about the company, you care about Elon and his other companies, the way to go is going to be the Republican vote. And for a very simple reason, I think streamlined regulation is the bottleneck. And I think that's why it's focusing on politics so much. And as much as it rubs people the wrong way sometimes, for some people, it's very necessary. You can't transition the world to sustainable energy without these things being solved. And I see examples of it in every interview, every data I look, from Tesla Energy Megapack rollout to now the semi interview. These things come up. Things that should be taking few days are taking 3 years. So, I mean, I totally understand. Okay, 3 minutes to decision, Alexander.
Hello, I was wanted to talk about semi in Europe. I was actually very happy to see this interview made in Europe. And I think the European truck market is ready for disruption. I mean, the total market now is about 320,000 units. And I mean, I see a lot of semi trucks in Sweden when I drive on the highways, and I wish those were Teslas instead.
All right, great. The other thing about this Fed cut decision, we're going to talk about semi in the coming episodes again. Thank you, Alexander. And I want your opinion about these founders of small utilities that they mentioned in the interview, which is kind of crazy, but not surprising. But anyway, the other thing about this Fed decision is the fact that I've been checking, the mortgage rates have come down very dramatically in the last year, about 2%, and they continue to decline. We're now getting quotes for 5 handle in the 30-year fixed mortgages. So the impact on the housing market has been very minimal so far. You may have read some headlines today. A lot of the takes about the mortgage applications are just flat out wrong. There's not even a debt cap bounce in the mortgage applications right now. Purchase mortgage applications. A lot of the activity are refinancing, which really doesn't mean much. But on the auto loan side, we haven't yet seen new loan rates come down much. Okay, so despite yields coming down, despite Fed getting ready to cut rates, the new auto loan rates haven't yet declined. We have about a minute to go. Magic?
Hey, Yaman. Yeah, I mean, with regards to, I guess, auto loans, the thing is you're seeing a pickup in delinquencies. So even if rates come down, I mean, the interest rate is a derivative of both interest rate plus credit risk, right? So if interest rates come down but credit risk goes up, I think it kind of offsets. I think that's kind of what we're seeing there, but that's just my opinion. I had a question for Omar. You posted something about having material non-public information. Just wanted to know if you wanted to share it with us or give us an idea, and if that's why Elon didn't follow you, or you're in the doghouse. I don't know if you're still getting paid, but I don't know. Let's see. What do you have to do to get back in his favor?
Yeah, I don't actually have any material non-public information about the company. Obviously, it would be illegal to have material non-public information and trade on it. And if I were to commit insider trading, I probably wouldn't tweet about it. The joke in the tweet was that trying the latest version of FSD is like having material non-public information because you can kind of see the future of the company. You can see where they're going. But of course, this software is being rolled out to everybody now. There's tons of YouTube videos, including from me.
All right, breaking news. Fed cuts rates by 50 basis points, and therefore Yoda is no longer allowed to speak in this space. Yoda, thank you very much for your service up to this point. And we chose to go in a different direction. Anyway, Fed cuts rates 50 basis points. I'm just joking, of course. The median projection has 2 more 25 basis point cuts in 2024 for a total of 100 basis points this year. Fed Governor Mickey Bowman dissented in favor of a smaller 25 basis point cut. It's the first dissent by a governor since 2005. Okay. Let me just read you a couple of the changes that were made to the statement. I'm going to read the statement. I think we should spend more time listening to reading what the Fed says as opposed to what the talking heads say. Okay. Recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have slowed, which changed, by the way, from moderated. Okay, so job gains have slowed. So a recognition of the employment market slowing down pretty majorly. And the unemployment rate has moved up, but remains inflation has made further progress toward the committee's 2% objective, but remains somewhat elevated. So they added remains somewhat elevated, but major changes to that sentence. Okay. Inflation has further progressed toward the committee's 2% objective, but remains somewhat elevated. Yeah, I think they're referring there to the core CPI number that came in a little hot. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Okay. The committee has gained greater confidence. You know what? Yeah. Greater confidence that inflation is moving sustainable toward 2%. They added that sentence. Okay. And judges that the risks to achieving its employment inflation goals are roughly balanced. Okay, interesting. That's slightly different from what Powell's speech. Interesting. Wow. Wow, that's amazing. So he got that 50 basis point consensus despite adding that sentence there. That's amazing. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. Okay. In light of the progress on inflation and the balance of risks, the committee decided to lower the target range for the federal funds rate by 0.5 percentage point to 4.75% to 5%. In considering additional adjustment to the target rate for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. And here's what they removed. Okay, they removed the following sentence. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. Wow, okay. So they went from, in one meeting, they went from does not expect it will be appropriate to reduce to cutting 50 basis points. And this is a very dramatic, that's a big shift for the Fed. And Powell made it happen, and he got consensus around it. Omar?
I guess it turns out the Fed isn't stupid after all.
Yeah, right. According to Machine. There you go. I mean, I think they are still behind the curve despite this 50 basis point cut. But if they had cut 25, I think the recession would have started earlier. Anyway, another key takeaway from this statement is that they're signaling further cuts. Okay, so he's saying, in considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data. Okay, so there was a big middle ground of people who were calling for, I shouldn't say that. I should say Ed Yardeni, who is a big time consultant to institutional investors. Okay, was saying about a few weeks ago, he was saying, we're in the one and done camp of 25 basis point cut, one and done camp. He got rid of the one and done nonsense. But even as recent as yesterday, he was calling for a 25 basis. So he was wrong on multiple fronts, which is amazing. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming inflation information for the economic outlook, the committee would be prepared to adjust stance on monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessment will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. Okay, so very interesting. So let's see. Voting against this action was Michelle Bowman, who preferred to lower. Okay. Something got cut off there. Okay, so I guess Bowman wanted a 25 basis point cut. First dissent by a governor since 2005. Okay, I'll go back and see what that's about. Yeah, this is very good. I mean, this is very good. I still think there's going to be a recession in the coming months, but this is better than a 25 basis point cut as far as I'm concerned. So let's look at the financial markets reaction to this. Tesla stock is up 2%. Okay. Overall markets are up quite a bit, and then they retreated a little bit. Oil at 70. Let's look at the yield curve here a little bit. 2-year yield. Hold on one second. Wow. The NBC website is slow. All right, Omar, any thoughts?
Looks like the market likes it.
Yeah, it's a little early to tell because sometimes what happens is these, a lot of companies, investors put on hedges for these decisions, and you have to unwind those hedges a little bit at first. So we'll see the impact in the coming days. And
Often the market does a complete 180 when the press conference starts.
yeah, obviously we don't have that information yet, and that's why we have William in here. William is gonna pipe in the audio from the Fed presser in about 20 minutes. Yoda, would you like to acknowledge your loss? Take the L.
Well, yesterday, a gentleman by the name of Grant called me a moron, and I think he is right. I concede. I was too conservative. Congratulations to myself on what the market's going to do.
Okay, great. Do you expect an acceleration in inflation because of this move, 50 basis point cut?
I think Powell is a very smart man at the end of the day. He just crowned himself for saving the economy. Now, I think the inflation is in check. He probably saw some degradation to the economy that he didn't like. And ultimately, this is the right move that takes a rapid recession or a pronounced recession out of the equation. So good on him.
Okay, Omar, what do you think is going to be the impact of this 50 basis point cut on markets overall and Tesla stock in specific?
I think the market certainly views Tesla as rate sensitive. Musk himself has said that rates are a big factor in some of the EV slowdown they've seen. So I think this is going to be bullish for the auto business. The auto business really needed this. It's going to be reducing the risk of continued deterioration in the labor force and resulting recession. So lower probability of a recession, lower unemployment likely to result from this, as opposed to a 25 basis point cut or staying flat. It's the first rate cut in 4 years. I think the market probably views it as a good thing. The only sort of caveat is, well, Okay, does a 50 basis point cut really mean that the situation is much more serious than we even realized a week ago? That perhaps we're, closer to recession than people realize, that things could spiral out of control. But so far, the economic indicators we're seeing are not too alarming, to your point.
That's not my point. That's not my point. I disclaim. I disown what you just said. I think the situation is serious. I think that the Fed is behind the curve, and a 50 basis point cut versus a 25 basis point cut makes the situation slightly better. But I think they're going to continue to be behind the curve, and they're going to realize that in the coming months. And they shouldn't have kept the rates this high this long. But I want to make it clear, I am a bit negative on macro, but Tesla is by far the best positioned, not only the automaker, but I think the company to weather any sort of macro downturn in the coming years, in the coming year, let's say. And that's specifically because the balance sheet is clean. Tesla has the highest EV margins. EVs are the future. Tesla's competition, legacy automakers, are heavily indebted. They are not prepared for what's coming. They're on the other side of the spectrum. Tesla's one side of the spectrum in terms of preparedness for a recession. Legacy automakers are completely on the other side. And this is gonna take some time to play out, but it's gonna play out. And on the other end of it, Tesla is gonna be a primary beneficiary of well positioned for the future. Nick,
How do you think this 50-point basis cut is going to?
can you guys hear Nick?
Yeah, I
Yes.
can hear him.
Yeah, I can
Okay,
hear
I'll be
me.
back.
Yeah, man, come on. What's wrong with you? Can you hear me now, Yaman?
Go ahead. Go ahead.
How about now?
I can't hear you. Go ahead.
Okay, so how do you think this 50-point basis cut is going to impact the election, to get it a little into politics?
I don't think it's going to change much. I think we're going to hear from both candidates criticizing the Fed one way or another, and that would have been the case with the 25 basis point cut too. But I don't expect a huge change in the financial markets up to the election from here on. There's a lot of uncertainty. A lot of uncertainty on monetary side, a lot of uncertainty on fiscal side. I think institutional investors kind of take their time. They're going to wait until after the election to place some positions, depending on who's in power. But I don't expect the Fed's 25 versus 50 base point cut decision to alter the election results one way or another.
Yeah, I mean, we're 6 weeks away from the election now. So a 0.25 versus a 0.5 probably isn't going to change anyone's mind in that short of a time.
Yeah. Okay. 15 minutes to presser. Anything else we need to talk about Tesla related, Omar?
No, not that I can think of.
Okay. Yoda, anything
Oh,
on your side?
GM did join the supercharger network. They're selling an adapter for 225.
Yeah. Yeah. Amazing, right? I guess Ford is giving them away, but GM is charging.
Yeah. GM kind of screwing over their customers a little bit there. I would just give it to them for free, but, I guess they're losing too much money.
Mary's leading again on the losses. Rivian stock has been declining over the last few days as well.
Yeah, I think people are realizing that their savior Volkswagen is also broke. Hey, I'm gonna bail out my broke friend. Oh wait, I'm broke too.
Right, Jimmy?
Hey, I missed the semi truck stuff, but does Tesla have a future in having some type of transmission, electric transmission? Kia just like announced and released their long range motor that is kind of like a transmission. So I see that their company is going into a direction that's going to get them longer range.
Omar?
I mean, I don't even think the Tesla Semi has a transmission.
Jimmy?
I don't know. I feel like Tesla's going to have to start working on some new engineering because we need longer ranges, and I don't think we're going to get there with battery capacity because of weight. So I think Tesla needs to really start looking at remaking the motor with some type of transmission to get those longer ranges.
So the Tesla Semi has a single speed transmission, and it's just one less part, one less thing that can break. That really speaks to the lowest TCO that they talked about here. Like if you're Pepsi and Frito-Lay, you want these things on the road all the time. And the simplicity of the Semi compared to a diesel Semi is a big piece of that. So I think they're going to continue doing single speed transmissions. If you saw Elon's tweet earlier today, he said we think we can get to like what was it, like 1.2 or 1.4 kilowatt hours per mile, which this thing's got an 800 kilowatt hour battery in it right now, getting 500 miles. They could be even significantly above that. So the range hasn't really been something that they've complained about. They've said, they can do thousands of miles a day if they charge in between the day. They're doing a 300-mile and a 500-mile version right now. So I think there are other ways to bring efficiency gains rather than introducing a transmission, which would be something Tesla's never done before. Porsche does have an electric transmission on their Taycan, but there is a lot of beauty to just having a single speed without a transmission.
Okay, good. Learn code, quick point. Learn code, unmute yourself. Okay. Can you guys see him as a speaker?
I don't.
No.
Okay. Man, these bugs are crazy. Okay. Another point from the step table. Federal funds rate June projection. So the unemployment rate increased for 2024 to 4.4% from 4.0%. So they significantly increased the unemployment rate estimates for end of this year, 4.4%. They have it at 4.4% for 2025. And I think that's where the disconnect here is, that they think the unemployment rate is going to stay at 4.4% in 2025. I will take the over on that. I think we're going to see unemployment rate accelerating upwards. Omar, any thoughts?
I agree.
Yeah. And then let's see. I'm looking for a change in the terminal rate. Longer run rate, they have it at 2.9. June projection was 2.8. Central tendency to stay the same, 2.5 to 3.5. So not much of a change there. Okay.
Another 50 basis points and another 100 basis points next year.
Yeah. Yeah, I don't think people realize what's coming, but it's okay. Says this position well. That's all right. Machine is trying to change what we said in live chat. He called for 25, didn't he? He's like, be 50, just like I said. No, you didn't. Yes. All right.
Well, you said, I think it should be 50, but they'll do 25. But
Right,
they
right,
actually
right.
just did 50. I mean,
Yeah,
I think
exactly.
the article we read yesterday laid out the case really well for a 50, and I think he was spot on.
Yeah. You know what I realized? It doesn't matter what it should be. What matters is what they're gonna do. So predicting what they're gonna do is the question here. And so, all right, what do you guys want to talk about for 9 minutes? Any updates on FSD 1010? Optimus?
We're seeing it go out to a few more people, but nothing too earth shattering there. Hopefully, it continues to roll out today.
Nick, what's going on your side? Enjoying your Teslas?
Yeah, I'm on dad duty right now, so I'm trying to make sure my baby's not crying.
What does he think about Tesla?
He loves it. He's got a cool Tesla shirt from the Tesla store because had some people use my code, so got some referral gear for him. Cool one is made on Earth by humans.
That's awesome. Does he laugh when you accelerate?
He does not yet,
That's
but
because you're
most
not
of the time,
accelerating. It's because you're not accelerating fast enough. Are you flooring
yeah.
it?
Well, no, because Diana doesn't appreciate that. I mean, I have the booster in my Y long range, and I have the 3 performance, but I can never have it on sport mode.
Okay.
I could only do it when I drive by myself.
Yeah. Yep. All right. Let's see. Is William ready? Let's make some predictions. Let's make some
Ready to
predictions.
go.
I like making predictions because it really puts people on the spot, gets them on, get your thoughts on paper, and so that you don't become the next machine where you're trying to change and what you said to look reasonable, and learn from the variance. Learn from the variance. Is he even here? He's on YouTube and he's not on X. What is he doing? Steve says, what do you mean by I don't think people realize what's coming? Do you mean recession? Yeah, I do. Because I think unemployment will rise quite a bit. I don't think people realize specifically how quickly AI is going to, how quickly AI is improving. I don't think people realize. So I highly recommend people listen to on Monday's AI Amateurs. You can find it on YouTube channel. Easier to find on YouTube channel, or you can just scroll all the way down to Monday on my X profile. If you're on YouTube, go to the live tab and find AI Amateurs and listen about what's coming in the next few months, and what that means for joblessness, what that means for consumer spending, retail sales, auto sales, and then think about why Elon was cutting jobs left and right earlier this year and reducing debt last year, the year before. And man, machine is going nuts in live chat. It's like hyperactive. Hold on, I need to deal with this. Should I block him from live chat? You think? Can we do a test with William?
Yeah, let me pull that out.
I found the best place to watch it is on. I mean, where are you gonna watch it?
I think they broadcast it on YouTube.
Yeah, that's the best place to. Hal is not doing X spaces yet. Nick, did you listen to Trump's X space the other day?
I listened to a little bit of it. It was mostly him trying to talk about crypto, um, and pretty much he's not really in tune with it, but his sons are. So he's making a point to um, uh, be I guess, a believer in crypto and get that crowd going to be voting for him.
Yeah, they gotta get out to vote. Who do you think is gonna win that election? You think I saw some recent data that Harris was pulling ahead a little bit.
Yeah, I guess it depends on the polling data. Honestly, like you could find polls that show different, both candidates winning. So yeah, I don't know. I think there's a pollster that has a record of being right about all the um, presidents, and he came out and said that Harris was going to win, and he has a track record, I think, of like 20 years or so, or 25, 24 years.
Yeah, I mean 20, 25 years. That's still just 5, 6 elections. So very small sample size.
I mean, how many times have you got a coin flip right 6 times in a row?
Yeah, yeah. But how many of those 5, 6 elections were very close to 50-50? Right?
You're like a politician, not answering my question.
I know. I don't think I ever flipped a coin 5, 6 times in a row. But
Well, try it, but you got to call it out before.
which elections were very close? The 2000 election was very close, right? 2008 wasn't. 2016 was close. 2020 wasn't. So he got a couple of, maybe 2 or 3 elections. I don't think 2004 was close either. So he got 2 elections right, basically, is what you're saying.
Yeah, but still to get 6 in a row is hard. You got to do my experiment.
No. Okay. William?
I wish I had intro music.
I guess we can just talk over it.
Yeah. Under this beautiful music, please take a moment to actually, you know what? I should read our sponsors with this music on. Can you lower it just a little bit? Just lower it just a tad. Okay, thank you. Tesla Live is sponsored proudly by Joa, your go-to source for Tesla premium accessories. And because you're part of the Tesla Live community where you hear amazing elevated music, Joa is hooking you up. Use code TSLA Live for a special discount and pay more. Paymore buys, sells, trades, and recycles electronics because Paymore believes the best technology doesn't have to come at the cost of our planet or your wallets. Join the Paymore revolution. Visit one of their 100 stores near you. Thank you very much, everybody. All right, let's get going.
Wow, very professional ad read.
We're not hearing William.
Yeah, it's kind of like showing Powell walking onto the stage. He's about to start talking.
Okay, here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50? And how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make the? Sorry, thank you, sir. How do we figure out in the months ahead? Is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So, a couple things. A good place to start is the SEP. But let me start with what I said, which was that we're going to be making decisions meeting by meeting, based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that The actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where what the committee is thinking today, but the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Go ahead, Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, and they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect in the base case to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that. And that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open. And I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of opinion, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year?
Yeah, we're gonna take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina. Hi, Chair Powell. Gina Smilik, the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there. But so I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. So your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably under 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, "Oh, this is the new pace." You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level. And we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby.
Thank you, Colby Smith with the Financial Times. I'm just following up on Gina's question on rising unemployment. Is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market. But this is more sort of 2018, 17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that. And we're not hearing that from companies that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael
McKee with Bloomberg TV and radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So, and policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with this inflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one, probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be their wage increases, rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is. So we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person, as measured. It's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, that could go on and on. There are many, many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months. And, so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. On the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Neil. Thanks. Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed the unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question. You mean after we get through all of this? It's just great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me, and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. It's, again, we only know it by its works.
One more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so this is my fourth presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group. And then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed. And I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind, and it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation. The goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is?
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but the direction of travel is clear. And as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home. So because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria. Hi, Victoria Guido with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags. And I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is let's look. When at this meeting we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? We knew it's clear that we clearly, literally everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth. Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had we had a burst of inflation. Many other countries around the world had a similar burst of inflation. And when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really, it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on. And I think we've made real progress. We don't tell people how to think about the economy, of course. And of course, people are experiencing high prices as opposed to high inflation. And we understand that's painful.
Greg.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, there's a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about, is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah. So I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up to it. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
We'll give you the second question. So the answer to your question is that, yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes.
Hey Omar, I cut William off. I think we're probably in a good place here. I think can you guys hear me okay? The last few minutes is usually not too important. Omar, are you there?
Yeah, I'm still here.
Okay, great. So let's go through some of these notes. I thought that was pretty much as expected. The 4.4% unemployment rate is for forecast for 2024 is a bit surprising. Okay. So the Fed really does not want this unemployment rate to go up a lot. All right. And they recognize that there's some upside. The last reading was 4.2%.
Did the sound go out?
No, yeah, I moved William down. I think we're done with. He changed the profile picture. I love it. That's so funny. That's awesome. Okay, I'm gonna move William down. Nick, are you there? Okay, let's move him down. Hustleton, can you hear me? Can YouTube hear me? Okay, great.
Oh yeah, it's all good on YouTube as well.
All right, the 4.4% in the SCP projections table is, I think, notable because it is above what it should be. So right now, it seems like they have a situation where the inflation reading is higher than where it should be, and the unemployment rate is higher than where it should be, and or is headed in the direction next couple of months here, they think. Which is interesting because the initial weekly claims for unemployment benefits in recent weeks have come lower than people expected. So the layoffs have been lower than people expected, and yet the Fed forecasted an increase in the unemployment rate. Okay, so that's notable. I'm going to look under macro analyst. I published from our patrons, Macro Weekly, kind of reviewing this data point, which I think was extremely important going into this. I made a call that it's going to be 50 basis point. You can't see the top of our screens. And I've been calling for the 50 basis point cut for the last week or two, even when the market thought 95% probability of a 25 basis point cut. So it was a very contrarian call. And the reason why I was able to call that is because of what I published to my patrons. I follow this data very, very closely. Macro Weekly goes to only value patrons. Okay. The other notes, quantitative tightening will continue, he said. So they're going to continue to shrink the balance sheet, which is new information. Okay. I think that's very notable. And he said, we're not seeing rising layoffs from business contacts, which contradicts with their 4.4% forecast. And he also dodged a couple of questions on the employment front. He was asked very specific questions and he kind of gave a very short and general answer. So I think he's really worried about the employment market, and as he should be. Okay, that's where this whole 50 basis points coming from. So I'm going to be watching the employment market very closely in the coming weeks and months. He said, we do not think we're behind the curve, but this is a commitment that we do not want to fall behind it. And I think they're wrong. I think they are behind the curve, but we'll see. Nick?
Yeah, I thought there was like two things that he was focused on was the employment and also consumer affordability. And he probably like most of the speech, I would, you know, roughly say about 70 to 75%. He was more focused on the employment side of the market. So I think you're spot on. It seemed that he was scared in a sense.
Okay. So Nick T just posted a tweet as well, and his key takeaways. Let me just read these few points. He says it's definitely a series of cuts. Yeah, that's another big takeaway too. That we didn't know if it was going to be like we didn't know it was going to be a series of cuts. We thought it was, but there's a difference between thinking and knowing, obviously. So Powell made it clear that it's going to be a series of cuts, albeit a recalibration ahead. We have in fact begun the cutting cycle now. Okay? The larger cut was mostly about risk management. Quote, we do not think we're behind. You can take this as a sign of our commitment not to get behind. Yeah, which is exactly what I just pointed out. That was the key sentence, I thought. And then 3, the slowdown labor market bears watching, and we're watching. Okay. And then 4, one note that wasn't unabashedly dovish. Quote, it feels to me the neutral rate is probably significantly higher than it was back before the pandemic, when it looked like the real neutral rate might be negative. So Nick took that as one note that wasn't unabashedly dovish. How many negatives do you have to use here, dude? Wasn't unabashedly. Okay, so was best. Okay, never mind. I actually took that sentence. I noted that sentence too, but I took that sentence as a walk back from his previous position, which was we're not going back to those rates. And now he kind of switched to it. Feels to me that that's less certain than before. So I think Powell has a good handle on what's happening in the employment market and in terms of artificial intelligence and everything. But I think the rest of the committee and the interviews I watched throughout the last few days of ex-members, and I was like, this is very basic, superficial level of thinking. But I think Powell is smarter than the rest of the FOMC committee here. So, but they're still behind. They're gonna have to do more, and I'm not surprised that the market is coming back a little bit. Its volatility was up, now it came back a little bit, and I think it'll depend on how the employment market shapes up in the next few months. So we'll see. All right. Any questions, comments? Omar, what was your take?
Yeah, I mean, it struck me as there being this contrast in that Powell seemed to be trying to downplay things a little bit, soothe the market, say, hey, everything's great. Unemployment is basically at the natural rate. The economy's fine. Well, then why are you doing a 50 basis point cut? I think clearly the balance of risks has skewed much more heavily towards a deterioration of the labor market, which has the potential to snowball, right? So people get unemployed people buy fewer stuff, more people get unemployed, it has the potential to get very ugly, and yet they still haven't reached their 2% target. Obviously, cutting by 50 basis points makes that a little bit harder to achieve the 2% target, but they're kind of in a tough position because they are not welcoming any further deterioration in the labor market. They're concerned. So they are trying to make it seem like, oh, okay, everything's all great. But the fact that they went with the 50 instead of 25 basis points suggests that behind what they're saying, they're looking closely at the labor market and they're concerned about what they're seeing.
Okay, good summary. If you're watching this on YouTube, thank you, Hollis and Mika. Thank you very much for tipping through super chats. If you're watching this on YouTube, please give it a like and leave a comment after the live stream is over below the video. Thank you very much, everybody. And I will chat with you tomorrow. Take care.